Good day, everyone, and welcome to J.K. Michael's Knowledge Series. Today, we're going to be talking about debt as a financial management tool. Now, the first aspect of this is to understand the difference between good debt and bad debt. But to get the whole idea, let's go a little bit into context and background of why people borrow. Now, if we need to undertake projects or undertake activities and our cash or resources are not sufficient, then we are likely to borrow. We have a tendency to borrow. So if cash is insufficient to pay for purchases and needs, we need to conduct certain economic activities and cash is not sufficient, then we are likely to borrow. Now, debt should be evaluated based on what it is used to finance. There are two major things debt can be used for: long-term investment and short-term consumption. I want to get a new shoe, I want to get a new bag, I want to get new shirts, I want to get a laptop, I want to get a phone. That's short-term consumption, right? It would not really, we generally advise to avoid this. This would generally be classed as bad debt. And then long-term investment, borrowing for long-term investment is generally good. Why? Because long-term investment is more likely to provide a return or provide returns that are greater than the interest on the debt. Now, bad debt is, like I said, consumer debt is incurred for consumption rather than investment, does not create financial value or improve your wealth, requires future income, or it reduces your future income because you're going to be paying both the principal and the interest. Generally, bad debt will carry higher interest rates. Interest is not tax deductible. So if you even use interest to finance investments, then those interests will generally be tax deductible, right? It weakens long-term financial health. Good debt is investment-oriented debt. If you use debt to acquire assets and opportunities that will improve your financial position in the future, well, great. Carries lower interest rates rather than higher interest rates, right? Often tax deductible and subject to rules and limitations as provided by the government, and will generally have a tendency to increase your earning capacity or asset value if managed well. Now, education is not exactly a financial investment in the raw sense of the word. And do we class it also as a consumer debt? Right. Well, borrowing for education will be good debt because even though it's not a financial investment in the raw sense of the word, it would improve your standing, it will improve your capacity, it will improve your earnings power. I think the first debt I took, which was a couple of years ago, many years ago, was used to finance my PMP when I got my project management certification, and it improved my life at the time. I moved from what I was earning at that time to be earning about 3 or 4 times more in the next job I took. So borrowing for education should be considered good debt. Education will enhance your earning potential over the long term. Student loan interest may be tax deductible within certain limits. Debt, as a core principle, debt should support long-term financial growth, not short-term consumption. Keep that in mind. And it's very important to know when you have too much bad debt, right? Measuring bad debts. Now, when you want to evaluate how much bad debt you have on and improve your financial standing by reducing bad debt, right? First thing you want to do is separate the bad debt from the good debt. Bad debt is high interest debt that is used for what? Consumption. Items that will depreciate, like your phone, like your bags, fashionable bags, fashion items, cars, right? Okay. Calculate your bad debt danger ratio as bad debt divided by your what? Annual income. How much you earn in a year and what percentage of that is in bad debt. So imagine if you earn 2.3 million in a year, which is actually 2.3 million in a year, and then over 1 million of that is bad debt. So if you have 2.3 million annually, and then 1 million of that is bad debt, then what is your ratio? Let's look at it as a ratio and as a percentage. So 1 divided by what? 1.3. Then we're looking at what? 0.7, sorry, 1 divided by 2.3, and then we're looking at what? About 43% being what? 43% of your debt is what? Bad debt. So your bad debt over your total annual income. Bad debt over total annual income. So if your bad debt is 1 million, your total annual income is 43. Your total annual income is 2.3 million. Then we're looking at 43%. But if you want to do it in a simple ratio, it's 1:2.3, right? 1:2.3, and that is your what? Bad debt danger ratio. Now, healthy versus risky levels of bad debt. Now, bad debt above 25% of your annual income is bad. The example I gave now was a 43%, which is very, very dangerous. It signals what? Serious financial risk. Financially healthy levels of bad debt is 0, right? You want to have 0 bad debt. If you have bad debt that is greater than 25% of your annual income, it means that you are in soup. In the example I calculated, we're looking at a 43% at 1 million divided by 2.3 million as our total annual income. Carrying balances you cannot pay off monthly is not seen as healthy, and bad debt can grow rapidly, of course, due to things like interest and penalties, and can become unmanageable. Avoid them. Now, what are the guidelines on borrowing? Borrow only for investments that retain their value or increase their value over a period of time. Avoid borrowing for consumption that loses value or becomes worthless over time. Your ability to save towards financial goals is a key test of acceptable debt. If you find yourself not being able to save, and I want to stress this, if you find yourself not being able to save, it's a problem. So if your debt is always collecting or consuming your total income, hence you don't find yourself in a position where you can save, it's terrible, right? Work on reducing that. There's no fixed rule for how much debt is too much. Good debt will generally carry risk and does not always produce expected return, right? And that's about that, right? There's no fixed rule, sorry, concerning how much good debt is too much. Also know that even when you have good debt, they carry risk. There's no guarantee that good debt will generate return. So this is saying, even if it's good debt, don't go and do a 2.3 million over 2.3 million good debt over 2.3 million annual income, which is a annual income. In this case, you're looking at a 1:1, or 100% of your annual income is good debt, right? If the fact is good debt doesn't mean that we should be careless, right? And then just continue to pile and accumulate good debts because they are good. Now, the reason why is this. Number one, there is risk. There's always a chance that the investment will not work out. If the investment does not work out, then you will suffer the downside of that risk, right? Excessive good debts can still strain give financial strain. So this good debt, as it is, will still be expected that you pay interest. Now, actually, I don't think there's any lending institution that will give you 100% debt on your income, right? But I'm assuming that if this were possible, the interest charges will still be significant. So you want to even when dealing with good debt, you want to minimize how much debt you generally take on. Now, so we have what key questions that we would use to assess your good debt. First of all, is it able to meet your monthly expenses? Do you find yourself, after you finish paying off your debts and other obligations, do you find yourself being able to meet your monthly expenses without excess stress, right? Do you find the borrowing risk matching properly with the rewards, right? So if the risk of borrowing, which is the risk of default, as well as the interest payments you make, does not match with the potential rewards, then you might want to evaluate whether this is a good debt or bad debt. Your capacity to save adequately towards long-term goals are indications of whether you have a good debt or bad debt. Now, the lure of easy credit. Now, if you accumulate the right credit score, then you'd generally have easy credit, right? Credit is aggressively marketed to encourage people to borrow. Don't forget that every time you borrow, the person lending you earns interest. So the same way people sell you phones because they want to make a profit, that's the same way lending institutions sell you money so that they can be able to what? Earn interest. Easy access to credit can make you overspend. It can make you borrow and overspend. Be very careful of that. Advertising also, pay attention to what you consume with respect to advertising, because a lot of times people see what they like and then it encourages them to go and take on debt that might end up being unsustainable. Watch advertising, right? Now, so we also have what? Playing the credit card float. Now, credit cards can be used responsibly if you pay the balances in full each month. You want to make sure that what? Paying in full allows what? Temporary interest-free use of the bank's money. The grace period delays cash flow outflows compared to cash or checks. Credit cards offer convenience and consumer protection benefits. They should be avoided, however, if they encourage overspending or hinder your savings. So when using credit card, just make sure that you adopt the right behavior. Now, we also have what? Savings. Again, remember that one of the ways we know whether debt is good or bad is that we consider the impact of this debt on your savings. You should never sacrifice savings. Make sure that you always save, right? So how do we know that we have what? Debts that are sustainable? Well, do you find yourself being able to save? Right. Now, actual savings equal the change of net worth over the past years, right? So what you end up saving, and I'm going to show this using the next video, right? We're going to see how your savings can be able to improve your net worth in coming years, right? Net worth today minus net worth of 1 year ago measures your new savings. So your net worth would be, the change in your net worth will be what is cumulatively taken into your used to gain or acquire assets, right, from your income and expenditure statement. Appreciation of investment. So if you did not save, or maybe you bought shares, now pay attention to this. And let me just describe something. If I earn 100,000 in a month and I use up 70,000, okay, let's assume that this is my assets liability ratio and this is my net worth. And this, I think, is a good way to describe it. My net worth, I have 200,000 in assets. And then my liabilities is 100,000. My net worth is going to be, this is the assets. These are my liabilities or my debts. My net worth is going to be 100,000. Now, let us assume that my income is 100,000 and I ended up spending within the month or within the year 70,000. That means my savings is 30,000. So if annual income is 100 and then my expenditure is 70, then what is left over is my savings of 30. So next year, my net worth is supposed to improve by 30,000. So let's look at that. So my net worth will then become 230,000. Or I probably I make this 220,000 to purchase assets and I reduce my liabilities down to from 100,000 to 90,000. So I put in 20,000 into the purchase of new assets and I reduce my debt by 10,000. So my savings of 30,000 has been used to increase my assets or reduce my debt. Now I have a net worth of 220 minus 90,000, which is going to be 130. And you can see my 130 net worth being what? Golden. And I'm going to show this with practical examples, right, against the net worth calculations that we did in the last video, how to make that work. Right now, so going back there, right, we have what? Actual savings, right, will equal what? The changes in the net worth from the previous year. Another very important thing is your net worth today minus your net worth 1 year ago is just a testimony to how much you saved. The appreciation of investments. Now, there are assets that are $100 or 100,000 that would increase to 200,000, not because you added money, but because they appreciated in value. If the asset increase is not based on savings increase or new money from your income expenditure statement, but rather the shares you bought gained 100%, that's appreciation of assets. You don't consider them when calculating how much you saved. Declines in investment value may be added back for accuracy. And then, of course, personal income. So if there are declines in investment value, well, it does not measure your savings because even though your assets to liabilities reduced, your asset to liability ratio reduced, well, it reduced because your investments, instead of it to move up to 200, it fell down to 70,000. You want to make sure that you adjust that or you add it back so that you can be able to properly measure your savings effectiveness. Personal property and consumer goods, like we said, are not counted as assets. Your cars, your phone, I think we did that in our net worth calculations. We try as much as possible to avoid things like personal properties and consumer goods. We don't count them as investable strategic assets. Now, home value changes should be excluded, right? If your real estate appreciates, it's the equivalent of the appreciation of what? Assets or investments. So home value changes should be excluded. They are not savings. And then extra mortgage principal payments may count as savings. Regular monthly savings is an alternative. So if you know how much you save monthly, but that's an alternative to detailed calculation, which is looking at your net worth and working backwards. Like I said, you can look at your net worth and work backwards to be able to determine how much you saved. But if you simply do a computation of your regular monthly savings, well, that's an easy alternative to making the detailed calculation. Only newly saved monies should count as savings, not recycled or spent funds. And you want to aim to save about 5 to 10% of your annual income for your longer term goals. I'm going to ask a very simple question. How much of your current income do you save? Save up to 10%. There are people who do as high as 20, 25%. If you can manage that, just know that you will accelerate your ability to meet your long-term financial goals, right? Very, very important, right? Another thing you want to do is evaluate your investment knowledge. Do you understand investing? And I'm going to give a very simple questionnaire with a couple of questions, and I'll encourage you to answer them. Now, sound investment knowledge is essential if you're going to improve your financial position. If we want to get wealthy, if we want to achieve our financial goals, it's very important that we should understand investment, right? So if you want to have long-term financial health, understand investment. Investment mistakes can significantly harm your finances. Know how to assess your investment knowledge so that you can be able to identify gaps and understand your need for investment education. Gaps in knowledge means you need to focus on closing that gap and learn so that you can improve your investment. So let's look at the questions that would help us evaluate investment knowledge. Let's go on. All right. Now, number one, do you understand the investments you currently hold? Right. Now, let's look at that. Do you understand the investments you currently hold? Are you holding high-risk investment, low-risk, low-return investments? Are they diversified? What if these investments should fail? What do you stand to lose? What is the cost and the benefits of the investment you are holding? Is your short-term emergency money invested in areas where the principal does not fluctuate in value? So let me give you an example. Short-term emergency money is money that what John Maynard Keynes would have called precautionary motive for holding money. These are funds that are used to rescue you if things go sour, right? You don't want to put it in investment vehicles that can have very highly fluctuating values. You want to put them in safe investment vehicles where they will appreciate gradually and steadily. So you don't want to take your short-term emergency money and put in stocks, right? You don't want to put them in stocks. You can put them in money market funds, which are short-term and safer investment vehicles. Now, do you know your marginal income tax bracket? And do you factor it in your investment decision? Right now, marginal income tax bracket is the amount that you get to pay, the additional amount you get to pay as tax because of an additional earned income. So in Nigeria, if you earn about 1.2 million, right, 1.2 million annually, let's remove other factors. 800,000 is exposed to tax. Now, 800,000 from 1.2 million gives us 2 of 400,000. So 400,000 is exposed to the first level of taxes, which is about 15% of taxes, right? So we have 800,000 is not tax, right? So usually there are brackets, right? So at the first level, you're going to pay 15%. At the second level of income, you're going to pay maybe 18%, whatever, depending on the tax laws that are applicable in your state, in the jurisdiction where you operate. You need to know how every additional income will impact you in terms of taxation. So know your marginal income tax bracket and factor that in your financial decisions, your investment decisions. And then number four, for non-retirement investment, do you understand how they generate income and capital gains and where they are appropriate for your tax situation, right? So if you have non-retirement investments, how do they generate income and capital gains? Are they appropriate for your tax situation? You want to consider all of that. Now, are your investments diversified across different asset classes? Do you just have shares, or do you have shares? Do you have bonds? Do you have some fixed income investments? Do you have uh, RE, REITs, which is investment in not insurance, sorry, investment in real estate, right? You want to be able to diversify your investment across different asset classes and not depend on a single security or one type of investment. Diversification reduces risk. Asset concentration magnifies risk, right? So if you purchase only one type of stock, might purchase only one stock or only one type of stock, or you purchase only shares and you don't diversify into things like bonds, you don't diversify into things like commodities, you don't diversify into things like real estate, then you might find yourself being overexposed. Please pay attention to diversification. And then, is the money needed? I mean, the money you are investing, is the money needed for major expenditures in the next few years? The money you need for major expenditures in the next few years, do you invest them conservatively? Let me give you an example. Now, your house rent money should be invested conservatively. Generally, you want to buy cars, you want to build a house, and you are investing or you are saving towards them, you're investing towards them, towards these purchases, then you want to make sure that you put them in safer instruments, right? Low risk assets. So you want to use low risk assets that will appreciate steadily and gradually, right? Looking at maybe like a 22% rate of return on the money you put in these investment vehicles. That's a lower risk. And if you go on pursue very high risk assets, where we have things like shares or stock, you have things like cryptocurrency, you have things like currency arbitrage. Now, these are very high risk alternatives for building wealth. You want to ensure that the money you need for major expenditure in the next few years is invested conservatively. Is money earmarked for long-term goals, which is more than 5 years? Is it invested to achieve returns that will outpace inflation? So if you're buying a car, if you're saving to purchase a house, if you're saving to purchase a house and interest rate is 22%, oh sorry, inflation rate is 22%. Nigeria has a very high inflation rate. If the interest on your investment is 22%, then you're not working out with anything. If the inflation rate is actually 24% per annum, and your interest on investment is 22%, then you are losing 2% in the real value of your money. So if you have money earmarked for long-term goals, always make sure that you factor in inflation and you invest in instruments or investment vehicles that will outpace, right, inflation. So in an event that we have 24%, you want to aim at maybe something like a 27% what? Interest on what? In interest on your investment, 27% rate of return. Now, if you invest in individual stock, sorry, hold on. If you invest in individual stock, do you understand how to evaluate them using financial statements, competitive position, and valuation metrics? Very important. So for instance, you have shares like Guaranty Trust Bank shares, Access Bank, Zenith Bank shares, do we know how to be able to evaluate value, right? Know which assets to purchase, which assets to hold on to, right? It's very important, very, very important. One way you can be able to reduce your risk will be not to purchase individual stock, right? Instead of purchasing individual stock, you can use things like what ETF or exchange traded funds, right? To be able to reduce your risk. What it does is that we have just a small portion of all the major blue chip, high quality stock held together in a portfolio, and you just own a portion of it. But if you invest in individual stock, you should know that you are picking a greater level of risk, right? Do you understand how to evaluate them using financial statements, financial reports generated annually or semi-annually, right? You want to know how to be able to evaluate them. Do you understand their competitive position? Do you understand with their valuation position? Valuation position is do they generally constantly generate what additional value to you as an investor, right? Do you see their potential for generating additional value increasing in the near term? You want to make sure that you are investigating and properly researching organizations before you purchase their stock. If you work with a financial advisor, do you understand their recommendations? Do you feel comfortable with them? And their compensation, is their compensation structured to minimize conflict of interest? These are all questions that you should ask. These are all things that you should understand, right? Now, making and saving money are prerequisites. They're very important, but they do not guarantee financial success, right? So it's very important not only to focus on making money and investing it, but also focus on the quality of the investment. Financial success depends on choosing sound investments that meet your needs. Things like your goals, things like your risk appetite should be considered when making financial decisions. Poor investment choices can erase the benefits of earnings and savings. If you save 20% of your money and then you put it in a financial instrument that loses 100% of its value, well, then what did you save? Right. So it's very important to make the right investment choice. Lost money produces the same outcome as never having earned it. So it's not enough to earn to save. You should also watch where you put your money so you don't lose it. Investment mistake will reduce your ability to spend, to enjoy spending, or what meets your needs and wants. Make sure that you make the right investment decision. Learning effective investment strategy is essential so you don't waste your effort. Working and saving without investing properly will lead to stagnation. Plus 1 minus 1 is equal to 0, right? So you don't want to work and save money and then lose the value of what you saved to wrong investment. These are very, very important. Now, let's look at your understanding of insurance, right? Now, well, let's talk about insurance. Insurance is important to be able to protect us from risk, right? So what we do is that we'll engage an insurance service provider, and then we'll purchase an insurance cover, and then we'll pay premiums and insurance premiums. And then in the event that the loss does happen, then the insurance organization is obligated to indemnify us or to cover us for that loss. Well, if you have high value assets that can easily be lost, and if they get lost or if they get destroyed, then they can reduce your financial security significantly. You might want to protect them using the insurance mechanism. So let's look at these series of questions. Do you understand the individual coverages that insurance companies offer, the protection types, and the amount of policies you have? And if you don't have, do you understand the types that you should go after, depending on the kinds of assets that you should protect? Does your current insurance protection give you a sense, make sense given your current financial situation? So, like I said, you want to invest in high value assets that, if lost or if destroyed, would significantly affect your financial position. You don't want to take out insurance, especially expensive insurance, for low value items that would have no significant impact on your financial position, right? Now, if you won't be able to make it financially without your income, do you have an adequate long-term disability insurance coverage? Right. So if for any reason, have you ever considered the fact that you may not be able to work extensively if you have an accident, if there is a disability, and do you have a disability insurance cover? Now, if you have family members or dependents on your income, have you made provision for life insurance to protect them in the event of demise? And then, do you know when it makes sense to buy insurance through discount broker, fee-for-service advisors, or direct-to-consumer companies? And when it doesn't, now, this is another very important area, right? When should you buy insurance through discount brokers? When should you buy from fee-for-service advisors and direct-to-consumer company? When does it make sense to do this, and when does it not make sense to do this? Depending on your financial situation, the kind of asset you have, and the nature of the insurance package, then you should be able to assess the kind of insurance you should get through either of these three, right? So it's very important to assess that. This is a very, very big deal. And I hope that we've been able to learn something that we take along and implement in our finances, right? It's very, very important that we understand investments and insurance and savings and how they affect our financial well-being. Thank you very much for being a part of this class, and I hope you enjoyed what you learned. When we return, we're going to be talking about watching where our money goes. Now, we have two major statements. We have the income statement, and we have our statement of net worth. We're going to look at how our day-to-day spending and expenditure can affect our wealth. Our day-to-day income and expenditure, how we use them, can affect our wealth in the form of savings and investment, right? So thank you very much for being a part of this class, and I look forward to seeing you in the next video. Bye for now.